In today's video, we'll be looking at the best ETF to secure passive income. I'll be explaining the exact process of finding the right dividend yielding companies, some of the risks that come with dividend investing, and most importantly, how to maximize your returns and get the most out of this investing strategy. If you find the video helpful, make sure to drop a like for the YouTube algorithm and subscribe to the channel so you can stay updated with any future videos. Keep in mind, this video is just my opinion. I'm not a licensed financial advisor and take everything I say in this video with a very large grain of salt. Firstly, what is an ETF? ETF stands for Exchange Traded Fund. This is essentially an investment vehicle that has a particular goal. For example, you can have an ETF that will track a specific sector like healthcare, or you might have one that follows a certain commodity like gold or silver. And you can also have an ETF that will track the overall market performance of a particular company. Most notably, in America, you have the S&P 500 index. However, you can't directly invest into this. Therefore, investing companies, most notably iShares and Vanguard, will make ETF products whose sole purpose is to mimic the performance of the S&P 500, buying into exactly the same companies. And when you put the stock graphs side by side for the S&P 500 index and then compare it to its ETF equivalent, they have an identical stock graph and therefore have the exact same performance. We now need to know what a dividend is. Essentially, a dividend is a payback to a company's investors out of a company's profits. The company recognizes its investors as part owners in that business because they've contributed some of their own money to the growth of that company, and therefore when the business is profitable and doing well, it will pay back some of this money to its investors in the form of a dividend. A dividend is expressed as a percentage, typically ranging anywhere between 1% and 6%, and therefore the more money you have invested with a company, the more dividend payout you will get. For example, making 5% of $1,000 versus 5% of $10,000. You don't need to get too caught up on dividends, because only looking at a company's dividend payout or the percentage of dividend they give back to the investors is not a good rule of thumb to use when you're picking which companies you want to leave your money with. While it may look good on paper that a company has a high dividend, because essentially that's just guaranteed money for the investor, you have to make sure that the company is financially stable and can pay back this dividend routinely to its investors, because you don't want to get caught in a dividend trap where the company will routinely pay back a dividend or may even increase that dividend just to maintain shareholder confidence, when in reality the company might be doing quite poorly and really needs that money to stay afloat and to continue growing the business. The risk that you can get is getting a nice high routine dividend, say 5% plus, but then the share price of that business will be falling and overall you may be losing money. And just because a company pays a dividend doesn't mean it's necessarily a good thing, because it might overall be a lot better if that company held onto the money and didn't give it back to its shareholders and instead used it to grow the business. And the more the business grows, the more the share price increases, and therefore the more money you'll make from your investment. How do you know if a dividend company is worth investing into? Well, there's a few things to keep in mind. Firstly, is the company financially stable? Does it have a good positive cash flow? This will tell you if the business is doing well and can afford to pay out that dividend, so you don't get caught in that dividend trap. Because if it can't financially afford to pay out this dividend, no matter how high or how routine it is, you need to keep in mind that this can't be financially hurting the business. If the company doesn't have good cash flow or a consistent growth, then you can't comfortably predict how much money you'll make from it, and even worse, you might end up losing money overall from it, because all it's really doing is giving you a big dividend, but its overall value or the value of its share price is continually dropping. And overall, with your dividend, you should really be reinvesting that into the business so that you can maximize your growth over time. It can be a bit counterintuitive to just pocket your dividend and not reinvest it, because this will limit overall how much money you make from your investment, and putting that money back into the business to continue growing is the most productive thing that you can do. So keeping the previous criteria in mind, one of the best ETF investments that you can make for passive income is the Vanguard S&P 500 ETF. While this may not have the biggest dividend yield, sitting at just under 2%, what it does have is a very consistent growth over time, sitting anywhere between 8 to 10% per year. As I said earlier, essentially what this ETF is just a clone of the S&P 500, which again is the biggest 500 companies in America. This means your money will be routinely spread out amongst giants like Facebook, Google, Tesla, Amazon, all of these big branded American companies which have stood the test of time, and overall there's no one managing this fund, so there's no management fees, which can also be a big risk that can eat away at your investments with other types of ETFs. So there's no one actively managing or picking which companies are included in this ETF. They're simply placed in here and ranked based on their market cap, based on the size of the company. So this is ultimately very useful for you as the investor, because you know that all the companies in here are going to be amongst some of the biggest and most profitable ones in the world, with a very low management fee and a very consistent return of 8 to 10% per year. Keep in mind that with this investment, it's very much a long-term thing, and when I say long-term, I mean 10, 20, 30 years, because while the 8 to 10% per year is accurate, this is only over, again, that extended period of time, because as you can see here, there can be periods of time where this investment can do virtually nothing, going only up or down by a few percentage points, because here we can see a 10-year gap where there was very minimal change in the price of the S&P 500. But again, with this over a period of time, the return can be very predictable and very profitable. If we take a look at this compound interest calculator that will tell us exactly how much money we could make from this investment, the results can be quite staggering. So if we start off with an initial investment of $1,000 and then add $400 a month, which is roughly $100 a week, and we do this for a period of 32 years and with an interest rate of 10% per year, then we can get a return of over $1 million, having contributed very little in comparison to the total reward that we have. As you can see here, a lot of the heavy lifting is done by the stock market and that nice compounding effect of that interest year over year. Again, if we compare the results of the S&P 500 ETF, which is not specifically targeted towards a dividend yield, in comparison to another Vanguard ETF whose sole purpose is to have a higher dividend yield and focus on dividend yielding stocks. So as you can see here, this is the return for the Vanguard S&P 500 ETF, and it's got over 100% return over a 5-year period with only a 1.3% dividend yield. In comparison to the Vanguard high dividend yield ETF, which gives you a dividend yield of roughly 2.8% but only has a 48% increase in share price over a 5-year period. Now, while it may look better on paper with the dividend yield, you have to again focus in the rise of that share price into your overall returns. So this again illustrates my point why overall a nice consistent stock market return will beat out a higher dividend yield, as you can see from comparing these two investment ETFs. Now that you know which ETF is best for passive investing, you might be interested in learning about some of the common stock market investing mistakes to avoid. Check this video out on screen that will give you my top 7 investing mistakes to avoid. This is the video that I wish I saw when I first started investing, and it would have saved me a ton of time and money. Make sure to check out that video to make sure you don't make the same mistakes that I did.